The US and Iran have reached a ceasefire agreement, halting the immediate military escalation. This geopolitical resolution has triggered a massive institutional-grade relief rally across the markets. This data dashboard tracks crude oil futures, and it shows an instant deflationary shock. According to MarketWatch, crude prices collapsed, plunging to $95.25. The physical mechanism driving this 15.67% drop is the lifting of the blockade on the Strait of Hormuz. Millions of barrels of oil are suddenly flowing back into the global supply chain. The broader equity market responded aggressively to this sudden reduction in energy costs. The Dow Jones Industrial Average surged over 1,300 points, logging a 2.85% gain in a single session. Google Finance data confirms this strength is market-wide. The S&P 500 climbed 2.51%, the Nasdaq gained 2.80%, and the Russell 2000 led, up 2.97%. Retail momentum does not move indices 3% in a day. This volume represents institutional capital systematically repricing systemic risk. A rapid collapse in energy overhead acts as a massive, immediate stimulus for the broad economy. It frees up corporate operating capital and forces algorithms to rotate out of commodities and directly into equities. This chart tracks the VIX, the market's primary fear gauge. The index collapsed by 18.39%, settling down at the 21.04 level. A volatility crush of this map protection and buying the broader market. But the market faces a severe structural friction. On the exact same day the ceasefire was announced, the Federal Reserve released highly cautious FOMC minutes. The Fed maintains that core inflation will not cool overnight. The temporary relief at the gas pump does not immediately erase years of elevated consumer pricing pressure. Underlying bond yields and central bank commentary suggest that borrowing costs will remain restrictive for the foreseeable future. This creates a tension between immediate geopolitical relief and long-term monetary policy. Traders are reconciling a massive equity surge fueled by cheap energy against a yield environment that remains restrictive. To trade this divergence, we use sector rotation. Institutional capital is completely unsentimental. Algorithms ruthlessly abandon underperforming sectors to chase new catalysts. This heat map from FinViz isolates the immediate damage in the energy majors. ExxonMobil dropped 6.01% and Chevron fell 4.99% as capital fled the oil market. That capital immediately landed in fuel-dependent consumer cyclicals and technology. This reallocation is mechanical and instantaneous. Algorithms automatically sell the commodity risk and buy the downstream beneficiaries. Capital relocates during a rotation. As money exits lagging sectors and floods into new leaders, the trader's job is to follow that liquidity to the next breakout. The transport sector captures the most direct mathematical benefit of a deflationary oil shock. Jet fuel is the largest variable cost for aviation. This candlestick chart for Delta Airlines confirms the rotation. Delta gained 4.3. Semiconductors are entirely ignoring the Fed's rate warnings, driven instead by massive, sustained capital expenditure. This momentum chart for Intel highlights the sector leader for the day. Intel surged 11.42% to $58.95 following news of its Terafab AI project. NVDA also climbed 2.23%, proving the broader memory chip and AI infrastructure boom remains structurally intact. The technical context confirms this strength. MarketWatch reports the S&P 500 has smashed back above its key moving averages. According to FinViz screener data, 45.2% of all listed stocks are now trading back above their 50-day simple moving average. Institutional investors are deploying capital into processors and AI infrastructure as safe haven growth assets, utilizing their guaranteed revenue pipelines to weather any lingering interest rate uncertainty. To survive high volatility events, you must replace conviction with mathematics. Every trade begins with precise position sizing. The primary rule of capital preservation is strict limitation. You must limit your total portfolio risk to a maximum of 1 to 2% per trade. This candlestick chart demonstrates the danger of entry timing. You cannot chase vertical green candles on breakout days. Instead, utilize pullback entries. Wait for the price to retest the intraday VWAP or the newly reclaimed moving averages before committing capital. Demanding a mechanical pullback entry is the only way to mathematically justify your risk-to-reward ratio. If you buy the top of a volatile spike, your stop loss becomes prohibitively wide. This S&P 500 chart outlines how to define your mechanical invalidation levels, specifically using the 50-day simple moving average the market just reclaimed. If the asset or the index closes below the 50-day SMA, the technical justification for the position disappears. You exit the trade to preserve capital. For upside management, take partial profits when the trade reaches twice your initial risk, known as 2R. This secures capital and funds a risk-free runner position for the remaining shares. The market is aggressively pricing in the geopolitical relief of a ceasefire. Equities are surging on the expectation of cheap energy, but the systemic risk of elevated interest rates remains. Trade the micro catalyst in front of you, respect the macro trend, and execute your risk management mathematically.